There's a very important line hidden inside Vanguard's latest market outlook. And honestly, most retail investors will completely miss it. Because this report isn't really about oil prices, it's about something much bigger. It's about what happens when inflation comes back, while growth slows down at the same time. That combination has historically been one of the hardest environments for investors. And according to Vanguard, that risk is rising again. So, in this video, I want to decode what Vanguard is actually saying, how large institutions are thinking about markets right now, what they're quietly preparing for, and most importantly, what this means for normal investors trying to build wealth over the next decade. The core thesis of this report is actually very simple. Vanguard believes the global economy is entering a more unstable phase, where inflation may stay structurally higher than investors became used to over the last 15 years. And the trigger right now is energy. The report focuses heavily on rising oil prices linked to Middle East conflict. But the bigger institutional concern is this. What if inflation doesn't fully go away? Because for most of the post-2008 era, central banks had one major problem. Growth was too weak. Now they potentially have two problems at once: slowing growth and sticky inflation. That's a completely different regime. And when Vanguard uses the phrase stagflationary shock, that's not casual language. Stagflation basically means prices keep rising, but the economy weakens. Consumers feel poorer, businesses face higher costs. Central banks can't easily stimulate growth because inflation is still elevated. And this matters enormously for investing because the investing environment of the 2010s was built around low inflation, falling interest rates, cheap money, and expanding valuations. If rates stay higher for longer, that entire framework changes. Now here's the part most people will overlook. The really important signal in this report isn't that Vanguard thinks there's a crisis coming. It's that they think central banks may hesitate to rescue markets quickly. That's the key shift. For years, investors became conditioned to expect fast rate cuts anytime growth slowed. Bad economy? Central bank support arrives, markets wobble, liquidity returns. But Vanguard is basically saying, inflation changes the rules. And you can see it throughout the report. They repeatedly talk about central banks being trapped between two competing pressures: slowing growth and rising inflation. That's why they now expect fewer rate cuts in the United Kingdom, prolonged policy inertia in the United States, and a much more cautious global policy environment overall. This is extremely important because many investors still psychologically operate as if we're living in the 2010s, but institutions increasingly aren't. Institutions are slowly adapting to a world where money costs more, volatility is structurally higher, and diversification may work differently than people expect. There's another subtle point too. Vanguard openly says stagflation can hurt both stocks and bonds simultaneously. That's huge, because for decades, the classic 60-40 portfolio relied on bonds protecting investors when equities fell. But inflation complicates that relationship. And I think that's one of the biggest regime changes happening underneath markets right now. So, what does institutional positioning look like in this environment? Interestingly, Vanguard is not screaming panic. They're still relatively constructive long-term. But their positioning clearly favors resilience over speculation. A few things stand out. First, they continue emphasizing quality fixed income. Why? Because after years of near-zero rates, bonds finally generate meaningful yield again. That changes portfolio construction dramatically. Second, they appear more comfortable with value-oriented exposures than pure speculative growth, and that makes sense in a higher rate world. When rates are extremely low, future earnings become incredibly valuable. That's why long-duration growth assets exploded during the 2010s and pandemic era. But when rates rise, markets become less willing to pay extreme valuations for distant future growth. Third, they repeatedly highlight inflation persistence. That naturally favors energy exposure, commodities, real assets, and companies with pricing power. Not meme stocks, not hype, not story assets. Businesses that can survive tougher economic conditions. And there's another fascinating point buried near the end of the report. Despite all the short-term uncertainty, Vanguard still believes artificial intelligence could be transformational over the medium term. That's important, because institutions aren't abandoning innovation. They're just becoming more selective about price versus narrative. That's a very different mindset from speculative retail momentum chasing. Now here's the most important part. What does this actually mean for normal investors? I think there are 5 major lessons here. First, the era of effortless investing may be ending. And I don't mean investing won't work. I mean the environment may become less forgiving. From roughly 2009 through 2021, investors were heavily rewarded for simply buying risk. Almost everything went up eventually. Cheap money helped lift valuations everywhere. That may not be the dominant environment going forward. Second, cash flow and quality matter more again. In a higher rate world, actual earnings matter, balance sheets matter, free cash flow matters, durable businesses matter. This is a more adult market environment. Third, investors may need to emotionally adapt to higher volatility. One of the biggest psychological distortions of the last decade was assuming central banks would always quickly stabilize markets. But if inflation remains sticky, policymakers may tolerate more market pain than investors expect. That changes investor behavior. Fourth, global diversification probably matters more now than it has in years. One thing institutions understand deeply is that regimes change, leadership rotates, economic winners rotate, and finally, I think the biggest takeaway is this. Normal investors should spend less time trying to predict headlines and more time understanding structural forces, because institutions don't invest based on social media sentiment. They invest based on inflation regimes, liquidity conditions, policy shifts, energy costs, demographics, productivity, and capital flows. That's the real game. And honestly, that's why I think decoding institutional research is so valuable. Not because institutions are always right, they're not, but because they're often thinking about the world at a deeper structural level than most retail commentary online. So overall, Vanguard's message is relatively clear. They don't necessarily see catastrophe, but they do see a more complicated investing environment ahead. Higher inflation risks, more constrained central banks, higher for longer rates, and potentially a very different market regime than the one investors became comfortable with over the last decade. And honestly, that may be one of the most important investing conversations of the next several years. If you enjoy this style of content, where we decode institutional research into plain English, subscribe to the channel and let me know in the comments. Do you think markets are entering a genuinely new regime? Or do you think this is just another temporary inflation scare? Thanks for watching.